dragging the markets lower. But let's get in Shiv Diwan, the MD and head of Nuvama Institutional Equities, who's joining us now from the sidelines of the 21st Nuvama India Conference for his views. Shiv, thanks very much for being with us here on CNBC TV 18. To begin with, what's the mood like at the conference? You've been speaking to a whole host of companies and investors. What's your one big takeaway?
First of all, thank you so much for getting me on the show. It's been a great couple of days. Today we're on day 3, so hope this is the final day. And I think it's been a mix. We've had a huge number of domestics and international clients coming in. I think we're talking about almost 1,000 individual investors over these days. And I think the mood is interesting. On the one hand, we have quite a few people who are now starting to look at India from thinking that it's now becoming much better. Earnings are starting to sort of gradually come back. We are seeing some green shoots of recovery on that front. Initially last year around we had some of these companies that had sort of gone up very high in terms of valuations, and earnings were yet to play catch up. We're starting to now see that slowly and steadily. I mean, you've seen some of the large names like Titan, L&T, SBI, etc. That have come up with good numbers. So the expectation is that from here on things should start getting better.
All right. Shiv, most of last year we saw these domestic flows being the big shock absorber for the markets. But now, the past few sessions, we've seen foreign investors come back. There's been some net buying that we're seeing on a day-to-day basis. What's your sense from your FII clients you've been speaking to? More of a tactical trade, or structurally, are you seeing a shift that is underway with the trade deal that we have and some of the earnings improvement that you yourself spoke of as well? And where is this incremental money from the FIIs really getting allocated to?
No, it's interesting you mentioned that. Yes, we've had 7 months of negative flows from FPIs, and we've started off this month pretty well. We've had a few days of positive flows, so we're hoping that continues. But yes, based on obviously on the sidelines of this investor conference, we have been having multiple conversations. People are keenly watching this space in terms of where the pockets of growth are, where things are starting to look more interesting. There are of course a few sectors which I can get into later, but there is definitely an undercurrent that people do want to start looking at India, and I think to start off with the large caps, and then maybe a quarter or two out, I think you should start to see the same sort of excitement developing in mid caps and small caps as their earnings start to play catch up. So yeah, that's the way we're looking at it. Of course, I should also add the caveat that while valuations have become better on a relative basis to other emerging markets, I mean, at the start of last year, our premium to other emerging markets was at probably 70%. We're now at about 55%. So it has definitely come back to its long-term averages, and which is sort of got people to start looking back at India. But when you look at certain stock-specific or sector-specific action, there are names in India that are still a little more expensive than people would like, especially on the FII side. And the fact that we've been seeing strong domestic flows, for the last 48 months at a stretch, that gives us the feeling that you won't find the Indian markets becoming too cheap ever. So people will have to start to take that call sooner rather than later.
Okay, so when we talk about sector-specific calls that some of these investors will be taking, Shiv, what do the conversations suggest? Where are they finding comfort now? And what still looks very highly expensive to them? Or I would say they wouldn't want to put their money there.
So from an FPI perspective, I think banks obviously still take center stage. They still believe, most of these banks are looking good, and with the government's consumption push, with the recent rate cuts, banks are still in a good position. And I mean, we saw that with SBI's numbers as well. And like I said, I think this is a space that offers the kind of size and liquidity that FPIs would like. So that is definitely center stage. Autos, as a sector, has done really well, but people are still quite enthused about it. We're also starting to see some sort of excitement building up on chemicals after they come back from a longish capex cycle. So there are some green shoots of recovery there. And then healthcare and pharma is another space people like. I personally believe that, while tech has had a brunt of the pain over the last few months for various reasons, and the most recent one being AI, which has, taken up a lot of conversations over the last few weeks and especially over the last 2-3 days. Numbers and have seemed to have sort of come off quite a bit there. And so that could be an interesting play over the next few quarters if they sort of are able to pivot from, being a service-oriented play to a sort of solution-oriented play.
Shiv,
those are some of the sectors that we've had multiple discussions.
So, Shiv, when FPIs were taking money out of Indian markets, the conversation was that maybe it's because of uncertainty around US-India trade deal. That's what the impact we saw on rupee as well. The other was there's not enough earnings recovery that is coming by. Some of it is getting reversed, right? We are seeing earnings recovery in select mid-caps. Now we have some finality on US-India trade deal as well. What are the other risk factors now that market participants should be aware of, or they are talking about it in the conference?
So I think you're absolutely right. The Europe trade agreement, the US trade agreement, all this is a step in the right direction. Government's consumption push, the rate cuts, all of this has, has been a very big positive from an India standpoint. The one concern which is common across a lot of the FPIs we speak to is still, like I said, the valuations. Not everything is still, very cheap. And despite the fact that you've seen, countries like Taiwan, Korea, China, Japan do extremely well, you still have a fair amount of pockets of stocks there that are still trading cheaper. And this is what most FPIs tend to highlight. Discounts or rather the premium at which some of these Indian good quality names trade at is still anywhere between 30 to 50%. So that's the only concern that people have. And like I mentioned earlier, that because of the domestic flows, I'm not sure whether that premium is going to change anytime soon. So people will have to take a call at some point as to whether they are starting to see that growth and earnings recovery and want to start getting in early.
Shiv, just a couple of things. I wanted to dwell a little more on the IT space, because the markets seem to be trading those companies more on this global AI news flow and what's happening every day with new models and the disruption that may cause than the company fundamentals. We've seen a bit of a decent quarter from some of the big heavyweight IT names here, and yet you're seeing the kind of rout you're seeing in the IT space. What will trigger a re-rating from here? Any view also, secondly, on the mid-cap space?
Sure. No, I think on the IT pack, look, I think today, of course, there was some news around the H-1B visas, etc. This keeps coming every now and then. I don't think there's too much to read into that. But even over the last week, 10 days after what Anthropic and Palantir have been saying, there has been concern around, what happens to, employment on the IT side. But if you talk to some of the larger companies and in fact, some of the good quality, high quality mid-cap IT names, they've been categorically saying that, look, IT is going through a little bit of a shift. We've seen this time and again, in the past many years, that every 5, 7, 8 years, you see some sort of a shift that takes place in this sector, and then most of these companies tend to come back. This time around, it's just slightly different because there is a little bit of risk in terms of how employment is going to play out. But having said that, I think it's going to eventually have a positive impact on margins for these IT companies, and someone who can pivot extremely fast towards being solution-oriented rather than service-oriented, as I mentioned earlier, is probably going to be the prime beneficiary here. So it may not be as easy for every single IT company to come out of it, but at least those that can showcase this movement, I think should do extremely well over the next few quarters. And sorry, on your question on mid-caps, look, typically, when this kind of a cycle is playing out in the markets, it is the large caps that start to bring about the whole recovery process, and then the mid caps and small caps soon follow. I don't think this year is going to be any different. So for the first few quarters, it'll be a little bit more bottom up with large caps leading the way, and then as you go across this calendar year, you should start to see the small and mid caps also take part in this rally. But of course, it is not going to be extremely broad-based. It is definitely going to be far more of a stock-specific year than it was maybe 2 years ago.
All right, Shiv, we'll leave it at that. Thanks very much for taking time out and joining us from your conference, and we wish you the best with it. Thanks very much. Okay, we'll